So think about this for a second. Right now, there are millions of investors, maybe you're one of them, who believe their money is safe. I mean, they've done everything right. They bought the index funds, they diversified, they followed all the rules. But what if the very things designed for safety were actually hiding a massive risk? In this explainer, we're going to pull back the curtain on a hidden danger that might be just a couple of years down the road.
We're going to dive into a scenario that, frankly, most of the financial talking heads just aren't discussing yet. It's a structural crack in the system, one that could get busted wide open during a very specific kind of market event that some economists now see on the horizon for 2026. And here's the real kicker. The danger isn't coming from some crazy crypto bet or a risky new tech stock. No, it's hiding in plain sight, inside the most boring, most trusted, most recommended products sitting in your retirement account right now.
All right, first things first. Let's talk about the flaw in your safety net. This isn't about one bad company or a poor stock pick. This is a structural issue. It's baked right into the foundation of how most of us invest today, and honestly, most people have no idea it's even there.
So, what's at the heart of this problem? It's the passive index fund. You know it, right? It's become the default set-it-and-forget-it choice for literally millions of savers. It's the bedrock of modern retirement planning.
The idea behind it is actually pretty brilliant. Instead of paying some expensive manager to try and pick winners, the fund just automatically buys everything in an index, like the S&P 500. What do you get? Super low fees, instant diversification, and historically really, really good returns. It's no wonder it took over the world.
And when I say it took over the world, I mean it. Get this, since 2010, the amount of money in these passive funds has just exploded. We're talking from under $2 trillion to over $15 trillion today. Passive investing isn't just a strategy anymore. It is the market.
But all that success has created a hidden side effect, and you can see it right here. Because these funds buy stocks based on their size, all that new money, all those trillions of dollars, have poured into the biggest companies. Just look at this chart. The top 10 stocks now make up more than a third of the entire S&P 500. So your diversified fund of 500 stocks, well, it's a lot more concentrated than you think.
In academic circles, they call this the crowding problem. Most of the time, you'd never notice it. But what happens in a real crisis, when big institutions need cash, and they need it fast? Well, every single one of those passive funds is programmed to sell the exact same handful of stocks, all at the exact same time. And here's the critical part. When everyone is the seller, who's left to buy? There's no one on the other side of the trade to absorb the shock.
So why 2026? Why are we talking about that specific year? This brings us to part 2. This isn't about predicting some random out-of-the-blue crash. It's about looking at a few very specific, very large-scale economic conditions that are all lining up to converge right around that time.
There are three huge forces on a collision course. First, you've got what's being called the corporate debt wall. Trillions of dollars in cheap corporate loans that were taken out over the last decade are all coming due, and they'll have to be refinanced at today's much, much higher interest rates. Second, the central banks are still doing their QT unwind, which is just a fancy way of saying they are actively pulling cash out of the financial system. And third, you have the ongoing commercial real estate crisis, which is putting huge stress on the banking system. Now, any one of these would be a problem. The real concern is that if they all hit at the same time, they could create a massive system-wide scramble for cash, and that is the very definition of a liquidity crunch.
Okay, so let's bring this all back home. How would this kind of perfect storm actually impact a typical investor? To figure that out, let's take the classic 60-40 portfolio, 60% stocks, 40% bonds, and see where the weak points are when you put it under this kind of stress. When you run the test, 3 big vulnerabilities pop up immediately. First, that concentration problem we talked about. Your fund isn't really 500 stocks. It's a bet on about 10 tech giants, which are the very first things that trading algorithms are programmed to sell in a panic. Second, your bonds, your safe asset. Well, long-term bonds get absolutely crushed when interest rates spike. They don't act like a cushion, they become another anchor. And third, something called the liquidity illusion. Sure, you can always hit the sell button on your ETF, but in a true crisis, there's no guarantee anyone will be there to buy it from you at anything close to a fair price.
Now this brings us to the most important part of this whole conversation. I need to be really clear here. This is not about selling everything, stuffing cash under the mattress, and running for the hills. The goal isn't to predict the future. The goal is to position your portfolio for resilience, so it can actually handle this specific kind of shock.
I think the best way to frame this is with a simple analogy. You don't demolish your house just because you live in an area that gets earthquakes, right? Of course not.
You hire an engineer, you find the structural weak points, and you reinforce them so the house can stand when the ground starts shaking. That's exactly the mindset we need to bring to our portfolios.
So what do those reinforcements look like? Well, there are 3 really practical steps. First, you can reduce what's called duration risk by shifting some of your bond allocation from long-term to short-term bonds. Second, you can truly diversify by adding assets that don't just move in lockstep with big U.S. stocks, things like international stocks or certain commodities. And third, and this one is so important, build a liquidity buffer. Having cash on hand means you are never a forced seller at the worst possible moment.
So let's wrap this up with a crucial point. No one, and I mean no one, knows exactly what the future holds. This isn't a prediction of doom. What it is a risk analysis. It's about understanding that the underlying conditions of the market, the crowding into passive funds, the massive debt wall, the rise of algorithmic trading, these things are real. They are documented. This isn't a guess. It's just looking at the facts on the ground.
So I'll leave you with this question to think about. We all expect our portfolios to handle a normal 10% dip. We've seen those before. But is your portfolio actually built to survive a deep, structural shock? Understanding the difference between those two things might just be the most important work you do